Should we invest in robo-advisors? Which robo-advisors should I use? These are the questions that I get regularly. And it's hard to answer these questions, yeah. That's because each of the robo-advisors has different investing styles, different holdings, and different fees. And while some robo-advisors publish their reports, others do not. And that makes it hard to compare their performance. Seedly has tried compiling their returns, but there are still people who found that their results don't match the ones shown on Seedly. The only good comparison that I could find was from investment modes, but it didn't track banks' robo-advisors. That's because I also wanted to find out whether banks' robo-advisors were able to deliver a higher return given that they are charging a higher fee. Then how? bo bian lo? Track myself lo? That's why back in October 2022, I started investing my own money into these robo-advisors so that I could track the performance myself. Hopefully I don't lose money, yeah? The portfolios that I invested in were the main flagship portfolio of each robo-advisors that focuses on growth. The first portfolio is Syfe Equity 100. Syfe uses an investment strategy called Smart Beta, where it tries to tilt towards factors like growth and value, volatility, size, and country to generate better risk-adjusted returns. The second portfolio is Endowus flagship with 100% equity. Endowus is well known for their dimensional funds, where the funds tilt towards value, size, and profitability factors to try to give you a higher return over the long term. The third portfolio is StashAway General Investing Portfolio, set to the highest risk level. StashAway uses something called economic regime-based asset allocation, where depending on different economic regimes, you will try to re-optimize the portfolio to try to minimize risk and maximize returns. Then we have the MoneyOwl Dimensional Equity Portfolio. Their investment strategy is very similar to Endowus, where they also invest in dimensional funds. Though the difference is that while Endowus invests in 4 funds, MoneyOwl invests in just 2 funds. Next, DBS digiPortfolio's global portfolio at risk level 4, which they call Fast and Furious. DBS tries to achieve the best possible return over a 3 to 5 year investment cycle. And in order to do that, DBS will review and rebalance the portfolio every 3 months. Next, OCBC RoboInvest Aggressive Portfolio. I can't find too much information about the strategy used other than it's actively monitored and regularly rebalanced using a proprietary optimization algorithm. So those are the 7 portfolios that I invested in. And by the way, if you want to sign up to any of them, you can sign up using my links down below, yeah? So how did they perform? Check this out. Okay, the chart is a little messy, so let me explain. Here, I'm tracking the performance from 20th October 2022 to 28th February 2023. So that's about 4 months. The way I track was by going to the portfolio's performance chart, look at the return for the day, copy it over to a spreadsheet, look at the return for the next day, copy it over, repeat for all the days for all 7 robo-advisors. So that's super tedious. Took me almost 4 hours to do this. So here's my message to the robo-advisor team who I'm sure will be checking out this video. Hey, how you doing? Just wondering if you maybe could give me a better way to get the result? Please? Quick pause. Here are 4 reasons to sign up to Moomoo Singapore. 1. You can easily keep track of companies' news and announcements within the app. 2. Moomoo lets you easily analyze the company from both the technicals and fundamentals to help you make better decisions when investing in the company. 3. They have an active community where you can discuss stocks and investments with one another. And last but not least, they have further upgraded their latest promotion. For the first reward, when you deposit $100, you will get a $2 cashback daily for 10 days. Then, for the second reward, deposit $2K and perform 2 buy trades to get a free Coca-Cola stock worth around $80. And the ultimate reward, deposit $10,000 and perform 7 buy trades to get a $108 cash coupon. So, if you want to earn these rewards, you can sign up to Moomoo Singapore using my link down below. With that being said, let's get back to the video. After I've gotten the prices, I just calculated to see what's the return for every date. And that's how I ended up with this chart. From this chart, you can see that I timed the market perfectly, as I started investing in all of them right at the market bottom in October. and that makes me the god of investing. Just kidding. Besides tracking the 7 portfolios that I mentioned just now, I also wanted to find out how well the robo-advisors did compared to a simple ETF. So I added the S&P 500 ETF, SPY, and VWRA ETF, which tracks stocks from all around the world. And the result, there were 2 obvious branches that appeared. At the top, we have UOBAM RoboInvest, VWRA, and DBS digiPortfolio, and the rest were at the bottom. Then you'll be like, wow, UOBAM RoboInvest is outperforming everything ah. Hold up. It's important to remember that the difference in performance between the 2 branches is just 7 to 8%, which is not much. But now, the question is, why did this branch occur? Let's talk about VWRA first. How did VWRA outperform almost every single robo-advisor on this list? The answer is in its allocation. VWRA has 61% in North America, 17% in Europe, 11.3% in Pacific, and 10.5% in emerging markets. If we plot it on the chart, we will see why. In these past 4 months, Europe gave a 22% return, which outperformed all the other regions. So, with that logic, any portfolio that have a high allocation to Europe should perform well. So, I went and checked out the geographical allocation for each portfolio. And here's what I got. MoneyOwl has the highest number of Europe holdings, followed by StashAway and OCBC RoboInvest. But why are none of them at the top? What's going on? Let's talk about MoneyOwl first. As mentioned earlier, the special thing about MoneyOwl is that it only has 2 funds. 88% of the portfolio is in Dimensional Global Core Equity Fund, which represents the developed market. The remaining 12% is in Dimensional Emerging Large Cap Core Equity Fund to represent the emerging market. And MoneyOwl keeps the allocation the same no matter what. What this means is that when Europe grows a lot more compared to other regions, MoneyOwl will rebalance the portfolio to make it go back to the original 88%, 12% allocation. And because of that, it's unable to fully capture the recent Europe surge. Also, you will notice that the total region allocation doesn't add up to 100%. That's because both of these funds also invest in other regions like Brazil, South Africa, Saudi Arabia, Mexico, and so on. And some of these regions haven't been doing so well. So that's why MoneyOwl didn't perform as well as VWRA. Next, StashAway has the second highest amount of Europe holdings. It also has the second highest amount of gold holdings. Both gold and Europe performed quite well during that period. So by right, StashAway should perform really well, right? Well, not quite. Not only it wasn't doing so well, it also gave the lowest return. So what's going on here? I was super confused until I went back and checked the allocation back in October. That's when it started to make sense. Back then, StashAway had a huge 7.7% bond allocation and 15% in real estate, both of which moved a lot less compared to normal equities. As a result, StashAway missed out on the whole run-up in October. It was only around the 20th of December where they did a huge rebalancing of their portfolio by selling away almost 50% of the holdings and buying in new ones to end up with this current portfolio. So that's the thing about StashAway's strategy. It always tries to predict future economic regimes by re-optimizing the portfolio, or a strategy better known as timing the market. This strategy is supposed to help with reducing the downside while increasing the upside, though there are times where StashAway also timed the market wrongly. For example, selling away their China allocation right at the bottom of the market and missing out on the whole run up. And speaking of China, back then they had almost 0% China allocation, but now it has been increased back to 6%. But of course, it's still too early to tell whether this is a good strategy or not. So we will just have to continue checking StashAway performance over the long term. Besides StashAway, the other portfolio which also had a big Europe holdings is OCBC RoboInvest. The holdings barely changed as compared to back then. So why did it not do so well? The answer is simple. The portfolio had about 15% in gold and another 15% in bonds, both of which underperformed Europe holdings. And because of that, the portfolio didn't do so well. And sure enough, if you look at the individual performance, both the gold trust and the bond ETF aren't doing that well. But with that being said, there's still a good reason as to why OCBC RoboInvest invests in gold and bonds. That's because both of them typically do well during a market downturn. Hence, if ever the market boom again, we might see OCBC RoboInvest end up at the top. Moving on, DBS digiPortfolio. This portfolio is one of the winners here. To be honest, I was quite surprised to find this portfolio appearing at the top, as they have the highest number of bonds and a low allocation in Europe. So in theory, this portfolio shouldn't be doing so well, right? After examining it a little further, I realized it has something to do with their 30% Asia Pacific allocation, which is the highest among this list. The Pacific region actually came in second, outperforming the US and the emerging markets. If you look at the individual ETFs performance, you can see that Pacific-related ETFs are doing quite well, like Japan Large Cap Equity 15% return, China Equity 14% return, Asia ex-Japan Equity 23% return. And while the bond allocation is large, it didn't seem to slow down the portfolio's return. That's because the Europe and precious metals ETF had also largely contributed towards the return. Next, UOBAM RoboInvest, the top performing robo-advisor for this period. When I saw the graph, I'd be like, what the heck? Because back in October, it had this super big jump, bringing it from the last place all the way to the first place within a day. I even went to double check, triple check to make sure that I copied the right numbers. So what caused this jump? Looking at the holdings, it's only investing in 77% US and 20% Asia Pacific. So the reason would of course have to be Asia Pacific. As it turns out, that was really the case. Every other holdings were either losing money or barely making any money, except for the all-country Asia ex-Japan ETF, which back in November had a big jump and continue on its rally. And that's the reason why this portfolio is doing so well. Finally, I will talk about Syfe and Endowus together, because both of them have almost the same geographical allocation, same asset class, they even have similar investing strategies, where both of them are using some kind of tilt to produce higher long-term returns. And how did they perform? Very similar. So for now, there's nothing much to comment about them. Though, if US recovers one day, given that Syfe has 10% more allocation to US than Endowus, I would expect Syfe to outperform Endowus. Okay, here are my thoughts. While it's interesting to see their performance now, obviously, the 4-month period is too short and it's not a good measure by any means. As we have seen from the UOBAM RoboInvest WTF big jump, their short-term performance depends entirely on luck. For a more accurate picture, this experiment would have to continue for 10 to even 20 years, which hopefully by then, I'm still doing YouTube, But do comment down below and let me know, which do you think is the best robo-advisors? I would love to hear that. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.